How effective risk management can transform your trading. Hello, everybody. Welcome to today's morning coffee with Mike. I got my tea today. Morning tea with Mike. We're talking about panic to profit. How investment strategies can transform your trading. So, there's four ways that effective risk management can transform your trading. The four that we're going to talk about today. First, it's going to be selling into strength. Then we'll be talking about selling when momentum fades. We'll be talking about selling when support fades. And finally, we'll wrap things up with talking about how and when to cut your losses. So let's dive right into it. Selling into strength. Selling into strength is something that did not come naturally to me at all. It would be one of those things where I would have a list of rules all written out, and I would be staring at the chart, trying to think, "Oh, did it trigger some kind of a rule? Should I be selling into strength? Oh man, it's doing everything that I want this trade to do. It's making profits. I'm seeing my P&L go up. When should I sell into strength?" Right? It's confusing if you do it that way, and it's not optimal. The way to sell into strength, the way to automate it, is to pre-plan when you will sell into strength. Figure out what targets you're going to be selling at. Now, should you just pick randomly when you're going to sell into strength? Should it just be some arbitrary number? No, of course not. Here's how I sell into strength. I first look at, well, what is my average risk on a trade? What's the average amount that I risk? The average amount that I risk is roughly 5%. So every my first scale out, the first time that I'm going to sell into strength is going to be at a 5% gain. It's a token amount. I want to take a little bit off at that when I've made one times my risk, so that way I'm in profits. I've raised my stop to break even, and the trade is profitable. It's just a small token amount. It's only about 10% of the original position. Then from there, the next time that I want to sell into strength is when I get to twice my average gain, or roughly what my average win tends to be. My average win tends to be about twice what I risk. So when I get to approximately 10%, sometimes it's a little bit higher, sometimes it's a little bit lower, depending on general market conditions. All these things play a factor. I'll sell my next bit. And when I'm doing this, I'm setting up the orders ahead of time. So I'm pre-planning where I'm going to exit these portions of the trades. And I'm figuring all this stuff out even before the trade is even executed. So in the planning stage, I'm figuring out, okay, I'm going to sell this stock when it gets to this price. I'm going to sell a little bit more when it gets to that price. And then after all that's pre-planned, I go and I enter all that with the broker. Makes things a lot more easier. It takes the emotional component out of the equation. Why? Because it's all set up, right? Sure, there's a little bit of, oh, did my plan work out? Did I set this up right? But you're not sitting there trying to make an emotional decision, right? Well, like it's there, it's automated, it's going to work for you. So that's how I like to sell into strength. Now, let's talk about selling when momentum starts to fade. This is a good one. This is a popular one. There's a couple of different ways to sell when momentum begins to fade. Some people like to use moving averages, some people like to use ATRs. I used to like those things too. And then I came up with a better strategy that's far more robust. In fact, I detail out all the specifics inside the Trading Mind Wheel. So if you haven't gotten the book yet, go grab a copy of the Trading Mind Wheel. It's available on Amazon, Barnes& and Noble, and everywhere that books are sold. Go get a copy. Overview of it, though, is that I will sell on danger signals. What are danger signals? Danger signals are signals that tell me that momentum is beginning to shift. But at the same time, I don't want to sell on just a couple of danger signals. I want the weight of evidence to be tipping the boat over to tell me, okay, it's time to take action. And so I detail out the different signals that I look for. A few of them, many of them are price action based. Many of them or a few of them are stochastics based. Uh, I use volume. I use volume weighted averages. So an anchored VWAP, if you've heard of that term. I use relative strength. I use a variety of things that will tell me if momentum is beginning to fade. Because what used to happen would be that I would see, oh, this moving average is breaking. It's the first time that it broke it, and I would be gone. And then what would inevitably happen? The price would continue to run up without me. So just because one day looks bad, it doesn't necessarily mean that it's time to exit the trade. Danger signals ended up being a far more effective way to manage trades. So selling on danger signals, selling when the momentum fades. Number three, selling when support breaks. So, how do you identify support and how do you identify support that you should be selling on? Great questions. The way that I like to do it is to do a multi time frame analysis. So, on any trade that I'm in, whether I'm trading a stock, whether I'm trading crypto, I want to do a multi time frame analysis, which means that I'll be looking at monthly charts, I'll be looking at weekly charts, I'll be looking at daily charts, I'll be looking at intraday charts as well to find where the significant levels all line up. And where they all line up, that's where I want my stock to be below that. Because if that level breaks, then that would be like you're walking across the floor, and then all of a sudden there's a hole. Right? There shouldn't be a hole in the floor. If the price falls through the floor, then that's it, gone. You're out. And the thing, fourth way to effectively manage risk is to be setting your stop loss. Now, very similar to when support breaks, as a trade has already progressed and you're locking in profits, the stop loss, that initial stop, should be on a spot where, okay, there's a hole in the floor, and I don't want to fall through that, so I'm going to stop right there. Ideally, when you're figuring out where you're going to place your stop, you're going to want to have multiple layers of confluence around that stop loss area. Some layers include that multi-time frame analysis that we just spoke about earlier. You might be looking at having moving averages around a certain area. Depending on what indicators you look at. Maybe you're looking at Bollinger Bands, maybe you're looking at Fibonacci's, whatever, it doesn't really matter. Well, when it comes to indicators, people tend to go overboard with indicators. The thing with indicators is that you're using the same set and you're using them consistently. That's what's going to allow you to pick up on the nuances of the indicator itself, as well as the how the indicator influences the different trades that you're in. You'll start to spot different things that, oh, when the stochastic crosses this way, that something tends to happen to price. And you'll start to pick up on those things, and you'll be able to use them effectively and make money with it. So those are the four uh, ways to effectively manage risk. Again, selling into strength, selling when momentum fades, selling when support breaks, and cutting losses. Let's see what questions you guys have on any of that. Type into the chat. If you're on Facebook, LinkedIn, YouTube, Twitter, type into the chat. If you're over here on Instagram, it would be helpful if you could use that little question bubble, but I will go through this list and take a look. And by the way, if you're not already subscribed, make sure that you subscribe, make sure that you like. That helps blast this out to a lot more people. Let's see what questions are coming in. Uh, Thank you for your time and wisdom. Great timing of the day. Yeah, absolutely. I really enjoy this new time of 11:30 a.m. Eastern. Let me know where you guys are in the world. Please, Hindi language. Sorry, I do not speak Hindi. I first need to master English. There's plenty of English words that I do not yet know. A couple of people are requesting to join live. So if you'd like to join me live, send me a message. Send me a private message and we'll work out a day and a time so that way we could bring you on for the full show. Go deep, answer questions on whatever topic you want to discuss, and you could be coached here live. Um, Send me a message on whatever platform it is that you're watching this on: Instagram, Facebook, LinkedIn, Twitter, YouTube. Just send me a message. Other questions? All right, I'll give you guys one more minute to get your questions in again. For those of you that already have the Trading Mind Wheel book, if you've read it and you got value from it, put a review in the spot that you bought it. If you bought it on Amazon, leave a review on Amazon. If you bought it on Barnes& and Noble, leave a review on Barnes& and Noble. What that's going to do is not only make me feel good that you're leaving a positive review, hopefully, but it's also going to get the book into the hands of more and more people. So go leave a review. And if you guys don't have any other questions, I see a lot of hearts coming in. I appreciate those. I see a lot of 100s coming in. I appreciate those over here on IG. But if you guys don't have any other questions, then we'll wrap it up and call it a day. Give you guys one more moment to get some questions in while I sip some tea. All right, it doesn't look like there's any other questions coming in. So here we go. Right at the buzzer. Right at the buzzer. Noah says, "What's your favorite indicator?" My favorite indicator is price followed up by volume. It's really the most important things. There's so much that could be read just by looking at price and volume. There's other indicators on my charts. Like I'll look at moving averages, I'll look at relative strength, but the main thing, everything is a derivative of price, volume, and of course, time. So uh, O'Neill used price and volume, and that was the main thing. If you haven't read O'Neill, I highly recommend that you go and you read O'Neill. Look through charts going back to 1880 to find the common elements of what makes stocks move and the types of patterns that they form before they make their big moves. Highly recommend that book, How to Make Money in Stocks. It changed my life and it'll change yours too. I mention William O'Neill quite a bit in my own book, The Trading Mind Wheel. Go get copies of both of them. All right, and I think we will wrap it up here. There aren't any other questions coming in. I want to say thank you all so much for joining me today. I appreciate it. We will be back here on Friday at 11:30 a.m. Eastern Time, and I'll see you then. Take care. Much love. Peace out, everybody.